If you are approaching retirement, or if you are already there, we need to have a serious, unfiltered reality check about your money. I know you are sitting there watching the markets fluctuate, looking at your retirement date, and feeling a deep, heavy sense of anxiety. You are asking yourself, am I going to run out of money? Do I actually understand the tools keeping me afloat? The single biggest asset most of you have right now is your 401k. But let me tell you what breaks my heart, so many of you have hundreds of thousands of dollars locked up in this account, and you do not truly understand how it works or the massive tax traps waiting to explode the minute you try to touch it. Fear comes from the unknown, my friends. When you are afraid, you make mistakes, costly mistakes that you cannot undo. So today, we are going to replace that fear with absolute financial clarity. What is a 401k? Stripped of all the confusing financial jargon, it is simply a special savings bucket created by Congress to encourage you to save for your own retirement. Your employer sets it up, and you put money directly into it from your paycheck. But here is where the road forks, and this is where so many people in their 50s and 60s make a critical error. There are two entirely different types of 401ks, and how they work determines how much money you actually get to keep. First, there is the traditional 401k. This is what most of you have been told to use for decades. When you put money into a traditional 401k, it is pre-tax. It lowers your taxable income today, and the money grows tax-deferred. Sounds beautiful, right? You feel like you are winning. But listen to me, tax-deferred does not mean tax-free. It means tax-postponed. You have entered into a business partnership with Uncle Sam, and Uncle Sam gets to decide what the tax rates are when you retire and start pulling that money out. Every single dollar you withdraw from a traditional 401k in retirement is taxed as ordinary income. Then we have the second option, the one I have been pounding the table on for years, the Roth 401k. With a Roth, you do not get a tax break today. You put in after-tax dollars. But the magic happens later. That money grows completely tax-free, and when you withdraw it in retirement after age 59 and a half, provided you've hit the 5-year rule, every single penny is yours. Uncle Sam cannot touch it. Why does this distinction matter so desperately to you right now? Because you are at the finish line. If you are sitting on a massive traditional 401k, you might look at your statement and see $1 million. You think, I am safe. I am secure. No, you are not. That is not your money. A massive chunk of that belongs to the Internal Revenue Service. And it gets worse for retirees. When you turn 73, the government forces you to take money out of that traditional 401k through required minimum distributions, or RMDs. They want their tax money, and they will force it out of your account whether you need it or not. If you fail to take that distribution, the penalty is a staggering 25% of what you were supposed to withdraw. But here is the hidden trap that almost nobody prepares for, and it catches retirees completely by surprise: Medicare. When those forced RMDs kick in from your traditional 401k, they spike your adjusted gross income. When your income spikes, it triggers something called IRMAA, the Income-Related Monthly Adjustment Amount. Medicare looks back at your income from 2 years prior. If your traditional 401k withdrawal pushes you over their strict income cliffs, your Medicare Part B and Part D premiums will skyrocket. You could end up paying hundreds or thousands of dollars more every single year for your healthcare, all because you pulled money out of the wrong bucket. A Roth 401k or a Roth IRA does not have RMDs, and those withdrawals do not count as income for Medicare purposes. It is a total pressure release valve for your retirement security. So, how does the 401k work once you are actually in it? The money doesn't just sit there as cash. You have to choose how it is invested, usually through a selection of mutual funds or target date funds provided by your employer's plan. If you are in your 20s, you can afford to take massive risks. But you are not in your 20s anymore. You cannot afford to let a market crash wipe out 30% or 40% of your nest egg right as you need to start living off of it. You must look at your asset allocation right now. You need to ensure you have a fortress of safety, a mix of equities for growth against inflation, but a significant portion in stable, predictable income generators like bonds or high-yield cash instruments within your plan to cover your fixed costs. I also see too many people in their 50s trying to borrow from their 401k to pay off credit cards or help their adult children. Do not you dare do that. When you take a loan from your 401k, you kill the compounding power of that money. And if you lose your job or leave your company, that loan often becomes due immediately. If you can't pay it back, it's treated as a withdrawal, meaning you get hit with income taxes on the spot. Protect your retirement first. You cannot take out a loan for your retirement, but your kids can take out a loan for college. So what is your actionable takeaway today? First, look at your most recent statements. Find out exactly how much of your 401k is traditional and how much is Roth. Second, check your employer's plan to see if they offer a Roth 401k option. If you are still working and making catch-up contributions, which are even higher for those of you 50 and older, strongly consider routing new contributions into the Roth side to build up a tax-free bucket. Third, if you are nearing retirement and realize 100% of your wealth is trapped in a traditional 401k, talk to a fiduciary financial advisor about a strategic Roth conversion strategy. You want to slowly convert chunks of that traditional money into a Roth account during lower income years, filling up your current tax bracket without crossing those dangerous Medicare IRMAA cliffs. You have worked too hard, for too many decades, to let confusion and fear drain your security at the exact moment you are supposed to enjoy it. Take control of your 401k, understand the tax rules, and protect your tomorrow, starting today.